Alright, welcome to the video. I haven't put out a video like this for a little while, but this is going to be a really real game changer for you, particularly if you're working on your craft of becoming a trader, becoming a better trader. And I'm going to go through something that happened to this week in the live room, actually yesterday in my live trading, my own personal trading. I was looking at taking a trade. We made the prediction, it played out, and we were spot on. The only thing I couldn't do is get involved because the entry criteria of my trade plan wasn't met. And everyone, normally people would say, oh, that's bad. Yeah, but you made the prediction, aren't you gutted that you didn't kind of get involved and make the profit? And my answer is, yeah, it's a little bit annoying, but I see it as a pat on the back for making the right prediction, and I didn't lose money. Okay, I left money on the table, but I didn't lose money. So I'm going to show you, I'm going to walk you through that, and then I'm going to talk you through a little process that I use that enables me to become a much better trader. And after this video is going to design to kind of open your mind as to how to build discretion as a trader, because you can't learn discretion, you have to earn it. And I'm going to give you a little process where you can actually force that onto yourself so that you can build that discretion a lot more quicker and become the best trader, the absolute best trader that you can possibly be. So make sure you watch to the end, and I'll go through the little process after I've been through this this analysis here. So this was the pound dollar on the daily. Okay, and what we were looking at on the pound dollar, I'll just run you through the analysis, my prediction for the pound dollar. My pound dollar prediction was bullish in this particular example. And what we were doing, just to kind of backtrack and get you up to speed on where we saw a hold, okay, at the 1.2 flat level. We had the double bottom, or the V bottom, whatever you want to call it. We violated the retracement and we started making our way up. And on the 4-hour time frame, we actually saw that reversal, and we actually saw, if I just scrunch out here, we actually saw that following putting in the lows and the lows, we actually violated putting a new high, then a new high, then a new high, and then we started to pull back. Okay, now where we were looking for a pullback to, where I was looking for a pullback to using my strategies, was right down here between 23.70 and 23.85s. Okay, and that was the zone that I had drawn on that met my trade plan rules for my entry criteria. And what happened was, the next day we started to pull down. Okay, so we dropped down to the 60. I'll show you it on the 60 because it's a little bit clearer. We dropped down into that area, and we was getting ready for the entry criteria. We was like, yep, this is where we're going to get involved. This is previous structure resistance, and we were looking for a pull into this zone. As soon as we pushed into this zone, then I'd start looking for the entry criteria. Well, of course, what happened is we just bounced off of the 124 level, and the targets were hit, the would-be targets were hit, I should say. The move was made. The prediction was to take targets at 2500. Okay, now that was a 100 pip move, and the prediction played out exactly how we predicted, except I wasn't able to capitalize on it. Now this is the purpose of post-market analysis, okay, journaling, and making predictions, and then following up with what happened, reading the tape and understanding how you can get better as a trader by doing this. Because if you're not doing this, what you're going to do is you're just going to keep taking trades, and it's going to take you forever to build discretion, because you're just literally learning it like you're learning a language, which will take a long time. Whereas if you're forcing discretion, that's how you become the best trader you can possibly be. So a little process that you might want to do, and I'm going to show you a very detailed process in just a minute. But a very nice process that you can do is during your post-market analysis. So you made the prediction, okay, and you had your entry criteria set out. What you can do that evening, or that after that trading session, is go back to what actually happened and analyze what actually happened, and try and identify any clues, any patterns, any behavioral patterns. Write it all down, journal it down in the notes. So for instance, we ended up reversing at 1.24 flat. Now there's the first clue. Okay, so what I'm going to do is I'm going to draw a horizontal line in there, And I'm going to color it in a different color so we can scroll out in a bit. So let's make this, I don't know, where's gold? That was a nice gold. That's nice and bright. We'll just thicken it up a little bit as well. Okay, so we reversed at 1.24 flat. Now 1.24 flat is an even handle number, psychological number. These numbers are respected in the markets, we know that. But as we look a little bit deeper, we can see that, well, what just happened recently? Okay, well, 1.24, we hit that like a wall following that strong breakout. We know that whenever a level is tested, in this instance it's resistance, whenever it's testing multiple times, the breakthrough is normally a strong bullish momentum candle to ensure the breakthrough. But you can see even that bullish momentum candle that broke through that resistance level held. It held just as we approached that, and then we opened up. We didn't dip below that level, then we continued up. Later on, we came down and tested that level again, and then we tested again. We had this low test candle wick here. So price action was telling us that this was actually a respected level and was giving us clues that there may be a hold at this level, and this might be more significant. So what you can then do is, if we just load out some more data here, and we scroll back, let's just scroll right out now historically. What I'm going to do actually is I'm going to draw on a horizontal line at the level we were looking at, and a horizontal line at the level that actually, the 24 level. And what we can do now as we're analysing the markets is we can scroll back historically, okay, and we can see, right, let's just go right back. As far as much data I've got on here, let's just see if we can, sorry if you're feeling a bit sick, I want to go back a little bit further here. So let's just say here, for instance, right, we can see that more often than not, that top level is respected. So one, right, the bottom level was respected here, we was respected the top level here, 1, 2, 3, 4, 5, 6, we actually respected it there as well, 7, 8, 9, okay, 10, 11, this one we dipped down to the lower level, so 1 or 2 dip down to the lower level, and then as we go into the future, very, very strong significance here, right, as we held that level, and whoops, even into most recently we held there, that was about a 1, we held both levels there, and then as we pushed up, we're back to where we were, and you can see that that level had strong significance. So then what you can do is you can mark this down and say, if I ever approach this level again, what I'm going to do, if we have this exact situation again and we get a pullback, I'm going to start looking for my entry at 124 flat instead of 123.80s, say. And what you can do is you can say, I'm going to have an entry criteria for 124, which might be a little bit more aggressive to catch the move, and then I'm going to be prepared to be maybe stopped out or re-enter or add to my position at 123.80. So you might have a lower stop loss, or you might just say, I'm going to get in at 124 with a stop loss here, in the, you know, the mindset that if I'm stopped out, I'm going to try and re-enter here, and then you're giving yourself a double high probability of getting involved in the move, if that makes sense. So that's how we kind of build discretion. Now, what I'm going to do is I'm going to show you a little process that you can go away and do right away now, to get you in terms of thinking how you can build discretion as a trader, because the purpose of you know, what we want to do is we want to generate nice, steady equity curves. No big oscillations, no big dips, no big drawdowns. We want a steady, slow oscillation that moves from bottom left to top right in your equity curve, or I do anyway. And we don't want any kind of drastic changes. I always use the analogy of the heating in your house. You know, you've got a thermostat on your wall, and so many people, when they're too hot, they'll just turn it right down. And then when they're too cold, they'll turn it right up. And then when they're too hot, they'll turn it right down. And they use this kind of on-off, you know, behavior towards their heating, when really if you wanted a comfortable temperature, you should just, if you're a little bit too hot, maybe crank it down half a degree and then give it a bit of time. And then crank it down another half a degree, give it a bit of time if you're still too hot. And eventually you'll find a sweet spot where you don't have these big oscillations and you don't have to change the heating all the time. And with trading, what you don't want to do is change too much at once. Once you're rolling and you've built a system with a positive expectancy and you're trading it and you're profitable, what you then want to do is just build discretion by understanding these little behavioral patterns in different markets, because they all behave different ways. I always call them my employees. They've all got different personalities, if you like. So let's just take a look at this little sheet here that I prepared. And on here, you're going to see that we've got a number of markets, so a number of pairs, and this is 1 week. This is over the course of 1 week. Now what you want to do is write all your pairs down, and a great exercise is just to go and make a prediction, whether it's going to go short or long, okay, bullish or bearish. So the first thing you do is make a prediction. This is a great exercise for you guys to do, even if this is all you're doing. Okay, because what you're going to do is you're going to start going through your pairs and just making a prediction, and then at the end of the day you're going to see whether you was correct or not. And that's all it is. Okay, so this is nothing to do with taking a trade or anything like that. This is just a prediction of the direction. And what you're doing by journaling this is you're forcing discretion. Whereas if you just, there's so many traders that go, I think that's going to go up, and then at the end of the day they'll go, I knew that went up, and then the next day they've forgotten it, and the next day they've forgotten it. Whereas if you've got a heat map here, a way of journaling this kind of stuff, you can really start to crunch the data and become a better trader using this data. So the first thing you want to do is make a prediction. Second column is to notify at the end of the day whether you was correct, or at the end of the trading session, whenever you do your post-market analysis, whether you was correct or not. Now you can see this particular week I was right 9 times out of 12, which is about 75% strike rate. Okay, so I was right 75%, which is that's good for me. Okay, normally I'm about 60% strike rate. So this was a 75% strike rate on this particular week. The next thing is you want to write down whether your entry criteria was met. Okay, so was your entry criteria met for the particular trade? Now you can see here that my entry criteria was met for this one, this one, this one, this one, this one, and this one. And where you've got a dash, that just means it wasn't met. And the next column, you've got the profit and loss. So this is the actual profit I made on the trades. And you can see this particular week, I made 4%. 4% return, but if my entry criteria was met 6 times and I only took 4, why is that? Well, that's because of correlation risk and de-risking my overall exposure to the markets based on my money management rules and my risk management rules. So you can see, for instance, my entry criteria was met here, my entry criteria was met here, and I took both of those trades and won. Whereas this one, I didn't take because I was already in a yen trade, which I wasn't allowed to take because I can't overexpose myself on the yen pairs. I can only be in 2 out of 3. Okay, so you can see that I had a pound yen trade on, I had a Aussie yen trade on, and I had a euro trade entry criteria met, but I couldn't take that particular trade. Makes sense? And the same with a pound Aussie, similar situation there where I can't be overexposed. So the point is, I'm not going to go into the details of all the trades, but the point is, I was right 9 times out of 12. Okay, I got my prediction right. Out of these 12 pairs, I was right on 9 of them. I had entry criteria met for 6 of them. I took 4 of them, and I generated a 4% return. Now, over here, you've got the different strategies for this particular setup. So this is a trend directional prediction. Okay, so this is my Graystone trend continuation. This is Graystone swing trading, and this is the daily chore, which doesn't apply to this particular one. I've got another sheet for that. And then what I want to do is in here, I put down what I would have earned on both strategies had I entered on both strategies regardless of whether or not I got in or not. So for instance here, so obviously here I've put what I would have made on the trend continuation, what I would have made on the swing trade, what I would have made on the trend continuation, what I would have made on the swing trade. And then here, the one that I didn't get in, I write down what I would have made on that as well. And the same here, I didn't get in on this one, but I wrote down what I would have made as well. And then what you get here is you can see that I would have made 6% and I would have made 8.29%, but I made 4. Okay, so going back to the trade that I just took, this process is very, very good at not, like stopping you from losing money in the market. Okay, very, very good at stopping you losing money. You've got a trade plan, which is this entry criteria, which is strict rules of engagement into each setup. And that is great having that because it allows you to not lose money. But what it also does is sometimes it means you're leaving money on the table. You're leaving money on the table, just like I did in the pound dollar, just like I did in this example here. So I got 4%, I could have got 8. So what I've got down here is this aggression increase. So this is to what tune I can become more aggressive if I want after I've collated lots of data. I wouldn't do it after a week, obviously. I would say do this for 6 months, okay, maybe a year. 6 months to a year, between 6 and 12 months, collect all this data. You don't want to be changing this after a month or 2 months or 3 months. That's not enough data to give you a realistic aggression increase. What you want to do is give it some time. Give it a nice sample size, 6 months to a year. Remember the heating thermostat. Don't want to change too much at once. And then let's just say, for instance, all of this data was over 6 months. Okay, you can see if this was 4, this was 6, this was 8. Using this particular strategy, let's just round this down. That's 8% and that's 4%. I can be twice as aggressive. Okay, so I can actually be twice as aggressive if I want to. So going back to this example, let's just use that strategy there. I got 4%. And I could get 8%, which means if I can be twice as aggressive, if I want, I can ignore my exposure, my risk exposure rules, and I can just say, sod that, I'm going to take all of these because I can afford to be twice as aggressive. Does that make sense? Now, if you can afford to be twice as aggressive, I wouldn't be twice as aggressive. I would consider being half as aggressive, okay, and just tweaking it up slightly. Then going another 6 months, then a half aggressive, then going another 6 months, then half aggressive. So I'm doing this process so that I know how I can build discretion and building almost a heat map to see where I'm leaving money on the table. Now, the great thing about this process is it doesn't have to be this comprehensive. You can just break it down and do bits at a time. So like I said earlier, just doing this exercise here, where you're making a prediction and then going, am I correct? No, that's great, because what you might do is you might have a really strong success rate on predicting a move. Let's just say that you trade the pound dollar and you say, right, that's going to move up, that's going to move down, that's going to move up, that's going to move up, and you get a 90% strike rate in your predictions, but your entry criteria only allowed you to get in 2 out of 20 trades. Well, then you can start looking at just these 3 things here and say, well, I'm definitely, I'm much more right than I'm wrong, but I'm only getting involved 2 times out of 30 or 20 or whatever it is. So I'm going to dial down and look at my entries. I'm going to see how aggressive I can be on those entries. Make sense? So I thought this would be very valuable to you, particularly for you guys who are just kind of going in the wind and like going year after year and not really progressing in your own mind. And it's because it's still in your mind. If you get it out on paper, get it down on a sheet, build discretion, write these numbers down. So with this trade now, I've written 1.24 down in my notes here. I've got these little post-it notes everywhere all over my desk. I've got these little notes where I say 1.24. If you use a system where you can set alerts, you can put an alert in there and say 1.24, if we ever approach this level again and we're in a trend directional setup, if we get a pullback, I'm going to look for aggressive entry there, and I'm going to use a 3-bar reversal or tweezer bottom candles or whatever it might be. So hopefully you got value from that. Let us know if you did. Let us know in the comments what you thought about this video and if you'd like to see more of this kind of stuff. But just take on board what I said, and if you do, you will absolutely be the best trader you can possibly be. So take care until next time. I'll see you then.